What if the recent global war tensions were not a threat to Bitcoin, but a stress test, and Bitcoin just passed it? When missiles were launched and global markets shook, Bitcoin briefly fell to $63,000, but within hours, buyers stepped in. Now the real question is this the calm before a breakout towards $75,000, or are we walking into a bull trap? Stay with me, because today we break down the on-chain data, ETF flows, funding rates, technical indicators, and institutional positioning to understand what's really happening beneath the surface. Bitcoin's reaction to global war shock. During the recent US-Israel-Iran conflict escalation, global markets reacted sharply. Oil surged, equities trembled, risk assets saw volatility. Bitcoin initially dropped to $63,000, a natural reaction during geopolitical stress. But what happened next was important. Instead of panic continuation, we saw a sharp rebound toward $67,000 by February 28th. This tells us something crucial. Bitcoin is increasingly behaving like a shock absorber rather than a panic amplifier. In previous war-like scenarios, Bitcoin often experienced prolonged downside. This time, buyers absorbed the supply quickly. That shift in behavior is not random. It reflects structural change in who owns Bitcoin today. Institutional confidence, the ETF signal. One of the strongest signals comes from spot ETF flows. According to SOSO data, Bitcoin spot ETFs recorded a total inflow of $458.19 million on March 2nd. Even more interesting, none of the 12 active ETFs recorded a net outflow that day. That's not retail panic behavior, that's coordinated institutional accumulation. When large asset managers see global uncertainty, they typically reduce exposure to high-risk assets. But this time, they increased exposure. That suggests something deeper. Institutions are starting to treat Bitcoin as a strategic allocation, not a speculative gamble. ETF inflows matter because they represent real spot buying pressure. These funds must purchase actual Bitcoin to back investor demand. When inflows stay positive during geopolitical chaos, it signals smart money confidence. And retail traders tend to follow that signal. Funding rate, what derivatives are telling us. Another important metric is the funding rate. Bitcoin's funding rate recently returned to positive territory at 0.0022%. Let's understand what that means. Funding rate greater than zero. When the funding rate is positive, it means long traders are paying short traders. In simple terms, more traders are betting on upside. If the rate becomes extremely high, it signals overheating. But at 0.0022%, this is moderate and healthy. It shows optimism, not euphoria. That's important. Sustainable rallies are built on steady positioning, not excessive leverage. On-chain data, whales and small holders. On-chain activity shows accumulation from both large and small holders. Whales, holding significant BTC, have been increasing balances during dips. At the same time, smaller holders are not distributing aggressively. This combination creates a supportive supply structure. Strong hands accumulating, weak hands not capitulating. No panic spike in exchange inflows. When supply on exchanges remains controlled, downside volatility is limited. That strengthens the case for a gradual upward expansion rather than a collapse. The technical picture, horizontal channel since early February. Bitcoin has been trading inside a horizontal channel since early February. Support, $65,000 to $65,700. Resistance, $69,600. Major breakout trigger, above $70,000. The price recently pulled back into the key demand zone around 65,000K
to 65,700K. This is technically healthy. After a bullish market structure shift, pullbacks into demand zones allow new buyers to enter. If buyers defend this level successfully, the next logical move is first target $69,600, second expansion zone $75,000. But we must also discuss risk. A breakdown below $63,800 would invalidate the bullish scenario. That level acts as structural support. Losing it would open the door to deeper correction. The Parabolic SAR, why it's still bearish. Now, let's address the indicator that contradicts the bullish narrative, the Parabolic SAR. This is a trend-following indicator. Dots below price is bullish momentum. Dots above price is bearish pressure. Currently, SAR dots remain above the price.
That suggests the broader trend has not fully flipped bullish yet. This doesn't mean price must fall. It simply means confirmation has not occurred. SAR is a lagging indicator. It reacts after strong movement. So, if Bitcoin breaks above 70K with volume, SAR would likely flip. Until then, it remains cautious. RSI at 42. Selling pressure or opportunity? The relative strength index is sitting around 42. An RSI near 40 is not oversold, but it's leaning toward the lower side. This tells us selling pressure exists, but we are not in extreme fear. There is room for upside momentum. If RSI turns upward from 40 to 45 range, while price holds support, it often signals momentum shift. That would align with the bullish breakout thesis. Why 75K is technically logical. If price breaks above the horizontal channel, expansion targets are calculated using previous impulse range projection. The prior bullish expansion created momentum structure that logically extends toward the 75K area. This level is not random. It represents psychological resistance, measured move projection, liquidity cluster above prior highs. Markets are drawn to liquidity, and above 70K, liquidity increases significantly. Macro environment. Why institutions see a dip opportunity. Global uncertainty often pushes capital towards safe assets. Traditionally, gold, U.S. Treasuries. Now, increasingly, Bitcoin. The resilience during war headlines may have strengthened Bitcoin's narrative as a non-sovereign asset. Institutions may be thinking long-term. Limited supply, 21 million cap, ETF accessibility, growing regulatory clarity, increased global adoption. Short-term volatility becomes an entry window in that framework. Risk factors you cannot ignore. No bullish thesis is complete without risk acknowledgement. Here are the key risks. Breakdown below $63,800. Sudden ETF outflow spike. Funding rate overheating aggressively. Escalation in geopolitical tensions triggering liquidity shock. If these conditions appear, bullish momentum weakens. Always watch structure, not emotion. Is this a bull trap? A bull trap occurs when price briefly breaks resistance but fails to sustain above it. To avoid that scenario, we need strong volume breakout above 70K, continued ETF inflows, funding rate gradually increasing, not spiking, RSI moving above 50. Without those confirmations, patience is required. Controlled expansion or deeper correction? Right now, the data presents a mixed but slightly constructive outlook. ETF inflows, positive. Funding rate, healthy. On-chain accumulation, visible. Demand zone, holding. SAR, still bearish. RSI below 50. Channel resistance, unbroken.
This is not explosive bullish momentum yet, but it is not structural weakness either. It is compression, and markets expand after compression. If buyers maintain control above 65K and break 70K decisively, 75K becomes a realistic expansion target. If 63.8K breaks, caution increases significantly. Bitcoin just faced a geopolitical stress test. It dipped, it absorbed pressure, and it stabilized. Now the market waits. Will institutions continue accumulating? Will 70K break? Or will macro uncertainty reclaim control? The next few sessions may define the trajectory towards 75K or a deeper reset. Stay analytical, stay disciplined, and never trade narratives, trade structure.